You know, everyone's watching the stock prices, but they're looking in completely the wrong place. The real story, the one that's actually going to determine where this market goes next, it's hidden. It's down in the engine room. So let's go find it.
So on one hand, the underlying data is screaming one thing, right? But then the headlines you see every single day are screaming the complete opposite. What is the truth here?
You see those headlines screaming crash, and you feel that anxiety building. It's everywhere. But what if all that fear is just based on a fundamental misunderstanding of what's really going on? We're about to close that gap.
Okay, let's dive into the first piece of this puzzle. The consensus view, the thing everyone seems to agree on, is that playing defense is the only smart move. But see, that assumes the economic cycle is ending. The data suggests that's a massive miscalculation.
The story everyone's telling is that the party's over, that this whole AI boom is just a bubble, and we're all just sitting around waiting for it to pop. But if you can just tune out that noise for a second and actually follow the money, you'll see the real story is just getting started.
Look, most people just watch the markets go up and down. This channel is for people who want to understand why they move. If you want to stay ahead of that curve, go ahead and subscribe.
So, where do we find the real evidence? Well, it's not in the wild, day-to-day swings of the stock market. Nope, it's in the boring, often overlooked economic reports that tell you what's actually happening on the ground.
Okay, so the biggest fear that's been haunting this market is that the Fed's rate hikes have finally done it. They've choked the life out of the economy. I mean, it makes sense, right? It's a logical fear. But the data is telling a very, very different story. And frankly, it's a much more bullish one.
This one number, this changes the entire equation. The Q3 GDP report was supposed to be decent, maybe good. But it wasn't just good. It was a complete blowout, shattering expectations by a full percentage point.
Just look at this. This isn't a minor rounding error in a forecast. This is a fundamental shift in what's happening. The whole market was positioned for a slowdown, and instead, what did it get? The strongest economic growth we've seen in years. This forces a complete do-over of that whole recession is just around the corner narrative.
And this wasn't some kind of fluke either. The growth was solid right across the board. You've got consumers spending more, businesses exporting, and here's the kicker. It's all happening without reigniting inflation. This is pretty much the Goldilocks scenario that investors basically dream about. An economy this strong doesn't just exist in a vacuum, right? It translates dollar for dollar directly to the bottom line for the companies that make up this market. And you can see that economic strength flowing right to the bottom line. Look, corporate profits are on an absolute tear, with domestic companies posting their best quarter of the year. This isn't just hope or hype, these are real hard numbers.
This brings us to what might be the single most important indicator for where the market goes next, the forward earnings slope. Just think of it like the market's collective bet on future profits. So as long as this line is pointing up, it means Wall Street believes companies are going to make more money tomorrow than they are today. A rising slope? Well, that's the lifeblood of a bull market. And as you can see, right now, it's still climbing.
But look, this strong economy is just the fuel. The real engine driving this market, the thing that separates the big winners from everybody else, is something way more powerful and way more concentrated. This right here, this is the heart of the whole thing. The entire bull market really rests on this one concept, hyperscaler CapEx. And this isn't about chasing the latest hot AI stock. No, this is about a massive, almost unstoppable wave of spending to build the physical foundation of the AI revolution. And for these tech giants, this spending, it's not optional. It's a matter of survival.
And we know exactly who's doing the spending. It's just a handful of these trillion-dollar companies. We're talking Microsoft, Google, Amazon, Meta. They are locked in an existential arms race to build the data centers, to secure the power, and to buy the chips that are going to power the future of AI. For them, this isn't just a line item on a budget, it's a bet on their very existence.
So once you see this massive, non-discretionary spending cycle as the true engine of the market, all the other day-to-day noise, the inflation reports, the Fed speeches, it all just starts to fade into the background. Now, a spending cycle this massive and this concentrated, it has a totally predictable consequence. It literally splits the market in two.
And this creates what we call a classic K-shaped market. On that top branch, you've got the infrastructure layer, the companies directly capturing all that hyperscaler spending.
So think NVIDIA with the chips, Supermicro building the servers, or even companies like Eaton and Vertiv providing the critical power and cooling. They are absolutely thriving. Then, on the bottom branch you have, well, everyone else. They're still exposed to all the pressures of the broader economy, but without that direct AI tailwind.
Okay, so with all these moving parts, a strong economy, rising profits, a massive AI spending boom, what is the one thing you actually need to pay attention to? What's the one signal that cuts through all of the noise?
It all comes down to this, the spending plans of the tech giants. That's it. This is the single point of failure. It's the fault line for the entire bull market. If they keep spending, the engine keeps running. If they even hint at stopping, the whole thing grinds to a halt.
Seriously, forget the inflation reports, forget the Fed meetings, the geopolitical drama. For now, it is all just noise. The only thing that really matters is whether these companies keep writing the checks.
So, here's what you need to do. Forget the headlines. Watch the earnings calls of these big tech companies. Actually listen to what their CEOs say about their future spending plans. As long as they're still committed to this AI build-out, this bull market has a green light.
And as long as the answer to that question is yes, then new market highs, they aren't a sign of a bubble. They're not just optimism. They are simply the logical consequence of an earnings engine that is still running strong. It's pure cause and effect.
Most investors are going to spend the rest of the year just chasing headlines and reacting to fear. But the real edge, the real alpha, is in understanding the underlying structure of the market before it becomes common knowledge. So if you want to keep your focus on the signals that actually matter, this is where we do that.